Alright, hi everyone. Welcome to today's webinar brought to you by IC Markets. Right, thanks for tuning in. Right, trust you've all had a great weekend. Right, I'm going to start things off with the disclaimer. Alright, so everyone, once again, and thank you for tuning in into today's pre-market live analysis brought to you by IC Markets. Right, as usual, before we start, please take note that this is marketing communication and does not contain and should not be construed as containing investment advice or an investment recommendation or an offer of or solicitation for transactions in financial instruments. Also, take note of the risk warning that comes with trading forex and CFDs. They carry a high level of risk to your capital, and you should only trade with money you can afford to lose. Right. So before we dive into the charts and trading view, we'll take a quick look at what are the key events that are lined up for this week. Then we'll start the analysis on the majors, and of course, should there be any requests as well, do not hesitate to drop them in the live chat box. Alright, my name is Ketan Rameshchandra. So this webinar series is brought to you in a special partnership between IC Markets and Everest Fortune Group, where we have been the finalists for Best FX and Equity Research for the following years, 2019, 2020, and 2021. Alright, so here's the calendar for Forex Factory, right, the economic calendar for this week. Right, so we've got a couple of central bank announcements. We've got the Reserve Bank of Australia, or the RBA, on Tuesday, it's on 7th of May. Right, take note, I'm on GMT time here, so at 4:30 a.m. GMT on Tuesday, 7th of May, the RBA will drop its cash rate announcement. Right, so currently the cash rate in Australia stands at 4.35%, and the estimates for this week shows an unchanged reading. So RBA is going to keep rates on hold once again. However, the statement and the press conference that's followed on 1 hour after the statement is released may suggest a potential dovish tilt by the RBA as coming up this week. Right, then we've also got the Bank of England on Thursday, 9th of May at 11 a.m. GMT, where they too are likely to keep their official bank rate on hold at 5.25%. Right, and after that we've got Governor Bailey delivering his speech as well at 11:30 a.m. Soon after. And we've got a few other things going on as well. We've got UK GDP data as well on Friday, 10th of May at 6 a.m. GMT. Right, so let's look at because we had the non-farm payrolls that were released last Friday. Right, the Bureau of Labor Statistics released its employment situation report last Friday, where we got the data for the non-farm payrolls as well as the unemployment rate. Now let's take a quick recap of this data point, because we saw this was quite a bad miss in terms of job growth. Right, so for the month of April, right, non-farms added 175,000 jobs versus the market expectations of 243,000. So you can see this was quite a pretty bad miss, right, highlighting the significant slowdown. And when we look at it over the average monthly gain over the preceding 12 months, we see NFPs have been adding about 242,000 jobs per month on average, and the reading for April came in at 175,000, see, much lower than the 12-month average as well as the estimate for that particular month as well. So this really highlights a significant slowdown in the pace of job growth. Right, and not only that, so not only did the pace of job growth slow down drastically, we also saw the unemployment rate edge higher. Right, previously in the month of March, unemployment rate was 3.8%. The estimate for April was also at 3.8%. It was supposed to be remain unchanged. However, it edged up slightly to 3.9%. So we had both the unemployment rate edging higher, coming in higher than the estimate, while non-farm payrolls missed pretty badly as well, which did trigger a pretty strong sell-off in the dollar. Right, we saw the dollar index drop quite sharply. However, it did retrace a little bit higher to but it did close down on Friday itself. Right, hi, morning Nick, great to see you as well. Right, okay, so we had a pretty bad NFP report last Friday. Remember, the Bureau of Labor Statistics released its employment situation report, where we got the latest data, or the data for the month of April, with regards to the unemployment rate as well as the non-farm payroll. So in short, this was a pretty bad miss in NFPs, and a slightly higher than anticipated unemployment rate, right? So pointing to a slowdown in the job growth market, and also unemployment is edging in the wrong direction, right? Moving in the wrong direction. So all this points to a weakness in the dollar, which we saw last Friday, right? Once we get into charts on trading, we will get a better idea of how the dollar was impacted last Friday, right? So since we've got two central bank announcements coming up, we've got the RBA first, right? As you can see here, it currently has maintained its cash rate at 4.3.5%. Now, services inflation has remained elevated, and it's still going to take time for the RBA to bring down inflation to their target of 2 to 3% by 2025, right? So if we look at the inflation rate or CPI data in Australia, so on the left, I have the chart for headline inflation or headline CPI on an annualized basis, and this is for the quarterly rate, and we've got the monthly CPI indicator on the right at an annualized rate as well. So as you can see here, in the first quarter of 2024, headline CPI edged lower from 4.1% to 3.6%. So you can see generally since the last quarter of 2022, right, Australia in inflation in Australia has been trending lower, moderating lower, so that's great. It's moving in the right direction. And when we look at it on the monthly indicator as well, since September of last year, it has trended lower as well, trended significantly lower over this 7 months as well, right? So you can see generally the trend or the direction of inflation in Australia is moving in the right direction. However, with the readings at 3.6 and 3.5%, it's still well above their target of 2 to 3%. So it's quite unlikely that the RBA is going to cut at this week's meeting, right? As we can see here, services inflation is still elevated, and both metrics for CPI are still well above the target of 2 to 3%. So it's quite likely they're going to keep their cash rate on hold at 4.35%. However, take note, should the statement and the press conference signal a little bit of dovish outlook or dovish communication, that could then potentially cause the Australian dollar to sell off, right? So take note, they are very likely going to maintain the cash rate at 4.35%. However, the statement and the press conference may suggest a dovish tilt, which could then potentially cause the Australian dollar to sell off, right? Then all right, and okay, part of another reason why they may not cut so early as well, right? We can see inflation is still well above the target of 2 to 3%, and we can also see Q1 growth, at least PMI output, has been pretty strong in the first quarter of 2024. So you can see January, February, March, April, right? We've had especially the last 3 months, we've had much stronger PMI output. This is the composite reading, so this encompasses both the manufacturing and the services sector. So we've had 3 strong months of output as well. So it's quite unlikely that the RBA may cut this week. Right, okay, then moving on to England, right? The Bank of England is going to update its official bank rate as well, and they too are likely to maintain their cash rate at 5.25%, right? So although and the policymakers are waiting for further clearer signals that inflation has truly subsided before they make that first rate cut. Now when we look at inflation in the UK, right, so on the left I have the headline inflation rate CPI year over year on the left, and on the right I have the core inflation rate on an annualized basis. So you can see both readings, 3.2% and 4.2%, are well above the target of 2%, right? The Bank of England also has an inflation target of around 2%, and headline CPI, which is on the left, and core CPI on the right, are both well above that target. So it's quite unlikely they're going to cut rates this week. Now similarly, when we look at PMI output in the UK, once again this is the reading for composite PMI, which once again encompasses the manufacturing and services sector. So you can see since the end of 2023 from November onwards, right? We can see PMI activity, which was previously contracting. Remember, a reading under 50 signals contraction, a reading above 50 signals expansion. So you can see generally that we have seen, right, this is the threshold of 50 here, right? Right, so we could see in the third and fourth quarter of 2023, we saw the PMI activity contract. However, since November, we've seen a pretty strong acceleration in PMI output. So because inflation is still well above the Bank of England's target of 2%, and with activity picking up relatively strongly over the last few months, once again, the UK is quite unlikely to cut its official bank rate. However, right, once again, the statement itself and the press conference by government Bailey may suggest a potential dovish outlook. Alright, okay, so now with that, let's dive on over to the charts on TradingView and start the analysis on the dollar index. Right, so I'm on UTC time here, right? So that's GMT. So when we look on the 30-minute chart for the dollar index, right, non-farm payroll was released at, I believe, oh, this is Friday, hang on, so it's going to be here, right? So let's just zoom in a bit, right, just to get to see what the price action was on non-farm payroll day last Friday. So take note that this data was released at 12:30 p.m. GMT, which is highlighted by this vertical green dotted line. So you can see here the dollar index was trading around 105.20 prior to the release of this data, and we saw a bad miss in NFP figures, as well as the unemployment rate edging higher. So you could see the dollar index dropping very sharply, going from about 105.20 to as low as about 104.50, so dropping about 70 pips in a matter of minutes. However, we did see it rebound quite strongly, so perhaps for today, right, could we see this bearish momentum continue, right? So that is why today's pivot has been identified as today's pivot at 105.02 has been identified as a downside confirmation level, right? So because we had bad NFP data and the unemployment rate edging higher, could we see the dollar index continue to sell off as the new trading week kicks off? So hence this level here has been identified as downside confirmation. So should we see a clean break below this level at 105, then of course the dollar index is quite likely going to drop down towards the first support at 104.09. However, take note, because we did see a very strong retracement in the dollar index, right, following the release of the NFP figure, we could see it move higher. So for today's call on the dollar index it's a little bit harder to pinpoint the direction clearly or clearly, because we do have a combination. Okay, we have a really bad NFP data miss, which should suggest the dollar continue to sell off. But when you look at the price action that followed the release of NFPs, the dollar index actually retraced higher as well. It recovered most of the initial losses to retrace higher. So the price action is actually the price action following the news release runs contrary to the actual data itself. So this is, to be honest, a little bit confusing as to why that happened. So perhaps that is why for this week I've highlighted 105 as the downside confirmation level. So if we see a clean break below 105, then of course the dollar index is quite likely going to continue to slide lower towards the first support. However, if the price action from last Friday continues with the retracement to the higher, then this level here could then potentially actually be a strong support level here, right? Okay, as you can see here, why is this level at 105 considered a downside confirmation level, right? Previously we can see back on November 2003, the dollar index bouncing off this level quite strongly here. Then once again It then proceeded to function as resistance in middle of February. You can see a very significant swing high resistance take place in the middle of February, as well as another swing high resistance that occurred at the beginning of April as well. So you can see quite clearly this is indeed a very significant overlap level which is currently being tested, or which was tested last Friday, right? We did see a very strong test of this level here, and not only that, we also have the presence of Fibonacci retracement at 61.8%. Now, this retracement is drawn from here, right? There's a couple of retracements. We have, oh no, sorry, this is a projection here. Wait, my retracement is here. Right, okay. So we started one retracement from here, this low on 9th of April, going up to the high here on the 3rd of May. We can see we have a presence of a 61.8% Fibonacci retracement that aligns very well with 105. And then when I draw a second retracement, this time starting from this swing low here on the 8th of March, going up to the high on the 16th of April, we can see we have the 38.2% Fibonacci retracement aligned very well with the 61.8 as well as the overlap level here, right? So that's how this overlap level has been identified. And it's pretty significant as well, and which was tested quite strongly last Friday, right? First support is this pullback level here, right? First support is this pullback level here that occurred on the beginning of April. And when we run the Fibonacci retracement as well, right, remember there's another retracement that we run from here, this swing low from 8th of March going up to the swing high on the 16th of April, we can see we have the presence of a 61.8% Fibonacci retracement around this level as well, so signifying or adding additional support to this pullback level here. Now, of course, when we look at resistance, right, the first resistance has been identified at this pullback level here that's occurred on the 30th of April and 1st of May. We also have the presence of a Fibonacci projection. Now this projection involves 3 points, so we started it here from point 1 on 9th of April, going up to point 2 on 16th, and of course going down to the low of last Friday here. We can see we have the presence of a 61.8% Fibonacci projection as well. That lies close to this pullback resistance at 106.30. So should we see the retracement in the dollar index continue to move higher once again, right, then of course we're looking at the 61.8% Fibonacci projection level as a major resistance point, which also aligns well with this pullback resistance here, right? Alright, hi morning Ren. Alright, sure, we'll alright, good evening. Yep, we'll definitely cover the pound as well, right? We're just starting off with the dollar index. We'll make our way down through a few of the major currency pairs. Of course, that'll include the pound. We'll also look at the Aussie as well, so we've got the RBA lined up this week, and then we'll jump on over to the commodities. But of course, along the way, do not hesitate to drop your requests in the chat box, and we're more than happy to go through the analysis with you. Alright, so this is what we have for the dollar index, right? So take note, it's a little bit tougher to call the direction on the dollar index this week. Remember, we had non-farm payrolls, which was a bad miss, unemployment rate edging higher, which caused the dollar index to sell off very sharply. However, the price action following the news release runs a bit contrary to the data point itself, so we did see the dollar index recover most of the initial losses to retrace higher, and that may mean we could see this week push higher as well. So that is why for this week I've labeled the level at 105, which is this significant overlap level, as a downside confirmation level here, right? So we need a clean break below 105 to see the dollar index continue to drop lower, and this that potential price action would give us a much better idea on the direction of the dollar index, at least for Monday and Tuesday. All right, okay, so now let's move on over to the pound, or let's do the euro first, then we'll do the pound. Right, so when we look at the euro as well, right, of course, with the dollar index selling off quite sharply last Friday, of course, so that means the currency pairs like the euro are going to rise higher. Now previously, this level here at 1.0743, which has been identified at today's pivot, right, this was a strong pullback support level here on the 1st of April. We can see price making a very significant swing low bounce off this level here at the beginning of April. And then you can see it's running into a little bit of resistance here on the 26 as well to create an overlap level here. Now, of course, with a bad NFP result, the US dollar sold off strongly, which of course then drove the euro dollar to break above this overlap resistance here. So it broke above its pivot here. We have a potential bullish breakout, so we could potentially see the euro continue to rise higher as well. So that means if the dollar index does continue to sell off, especially with a clean break below 105, then that would mean quite likely the euro is going to continue this bullish move up. Remember, it had a strong bullish breakout last Friday, and it could potentially rise up or continue rising at least towards 1.0800. And the first major resistance for the euro comes in at this pullback resistance here that occurred on the 9th of April. And not only that, right, we also have the presence of a Fibonacci retracement, right? So we started this retracement from this swing high here on the 8th of March, going down to the swing low here on the 16th of April. We can see that we have a presence of a 61.8% Fibonacci retracement, which aligns quite close to this pullback resistance at 1.0863 that occurred on the 9th of April. So this is a pretty strong resistance zone for the euro. Now, similarly for support, we see the euro making a pretty decent pullback here on last Wednesday, right? As the euro fell quite sharply on the 30th of April, it did find strong support around the region of 1.0664, right, before moving higher, before rebounding higher, right? This was a pretty strong rebound here, and this is also a level or a pullback support level that has the presence of a 78.6% Fibonacci retracement. So we started this retracement from this swing low on the 16th of April, going up to the NFP high on the 3rd of May. We can see that the 78.6% Fibonacci retracement also sits quite close to this pullback support at 1.0664 here. Right, so let's now move on to the pound. Right, so we've got the Bank of England releasing its monetary policy statement this week. Right, so should we see, okay, first of all, they're quite likely going to maintain the official bank rate at 5.25%, right? Because as we saw, inflation is still well above the target of 2% in the UK. Plus, we also see PMI output rebound quite strongly over the last 4 months. Right, so because of that, we may see stronger demand for the pound in the middle of this week, which could then potentially drive pound dollar higher. So once again, right, this level at 1.2554 is a pretty significant overlap level for the pound, right? See, previously it found pretty decent support here on 16th of Feb, middle of February, before bouncing higher. Then as it was falling sharply in the end of March, it found strong support here at the beginning of April to retrace a little bit higher as well. So you can see this is a strong support level here at the beginning of April, and another strong support level here on the 15th of February. Then, as of course price broke under and started to retrace higher towards the end of April, right, we can see price running to resistance here on the 29th of April, creating an overlap level here. So this was this level at 1.2554 was functioning as a overlap resistance level, which got broken last Friday, right? Okay, although it did spike higher, spiking as high as 1.2636, you can see it pulled back quite sharply. So that is why this level here, this overlap level here, I've identified it as a potential upside confirmation. So that what that means is, should we see the pound open today and rise strongly above 1.2554, we may get that confirmation of a potential bullish breakout. Right, remember the weak non-farm payrolls caused the pound to spike last Friday. However, we did see it pull back quite sharply, right? Remember 12, let me go on to the 30-minute time frame. We can see here 12:30 p.m. GMT, this was when the non-farm payrolls was released. It was bad, the dollar sold off strongly, so that means currency pairs like the euro and the pound spiked last Friday, with the pound going as high as 1.2635. but however it proceeded to pull back very sharply, erasing almost all the initial gains. Right, you can see it erased pretty much all the initial gains to close at around 1.2550. right. So that is why this level has been identified as a potential upside confirmation. So should we see the pound break above this level quite cleanly, then it's quite likely it's going to resume its upward trend. However, if that does not occur, then it's likely to pull back towards this overlap support level at 1.2482. Right, when we zoom in here, this level previously, right, functioned as a little bit of resistance here at 15th of April. After breaking lower here on the 12th, it functioned as resistance here, and then as it retraced higher, it functioned as strong support from the 26th of April till the 2nd of May. Right, so we have an overlap. Right, previously it was a pullback resistance here in mid-April, and towards the end of April it functioned as support, creating an overlap level here. And not only that, we've also run a Fibonacci retracement. Right, this retracement started from here, this swing low on the 22nd of April, of course going up to the NFP high on the 3rd of May. So we also see the presence of a 50% Fibonacci retracement aligned quite well with this overlap level here, right, together with the first support at 1.2482. Right, with regards to the first resistance, we see a strong pullback level at 1.2677. Right, we can see here as the pound bounced strongly off this overlap support here in early April, it rebounded quite strongly. However, it ran into resistance around 1.2677 here. And also, this is also a pullback level that has the presence of a 61.8% Fibonacci retracement. Right, we started this retracement from here, this swing high here on the 8th of March. Right, going down to this swing low here on the 22nd of April. Right, we see the presence of a 61.8% Fibonacci retracement that aligns very well with the pullback resistance here. Right, so this adds additional significance to this resistance level. Alright, Nick. Alright, sure, definitely going to cover the Aussie as well. Of course, with the RBA lining up on Tuesday, definitely we'll cover the Aussie as well. So similarly, when we look at the 30-minute time frame for the Aussie, right, non-farm payrolls released at 12:30. It was bad. On the Aussie, spikes from 65.78 to as high as 66.46 in a matter of minutes, right? So jumping about 66 pips or nearly 70 pips in a matter of minutes. But however, once again, you could see the price action reverse very strongly, and we could potentially see, if we do see this bullish momentum for the Aussie continue, right, if we do see that bullish momentum for the Aussie continue, it could run into resistance at 66.77, which has been identified as the pivot level, which is also a pullback resistance here. So we can see previously for the Aussie, as it was pulling back sharply at the beginning of January this year, right, it was pulling back sharply. It did find a little bit of support here from 5th of Jan till the 12th of Jan, right, for a period of about 5 or 6 trading days. It did consolidate around this level here to indicate a potential support before finally breaking through. And then as it was rising strongly in March as well, it ran into resistance here on the 8th of March before pulling back, although it didn't hit this level exactly, but you can see it came very close to this level, right, so creating an overlap here. And once again, it does look like it may have just shied away from this level last Friday as well. So this is a pretty significant overlap level here at 66.77, which has been identified as the pivot. Not only that, we also have the presence of a 61.8% Fibonacci retracement that aligns very well with the pivot, right? So we started this retracement from this swing high here on the 28th of December, ending with a swing low here on the 19th of April. We can see that the 61.8% Fibonacci retracement aligned very well with this overlap here. And also at the same time, we see the presence of a 78.6% Fibonacci retracement aligned pretty well with the first resistance, which has been identified at 67.62. right? In terms of support, right, this level at 65.65 was previously pullback resistance level, right? Previously you could see here price running through resistance here on the and in the end of April, right? It was rising strongly in the final week of April before pulling back over the next couple of days, right? So this was previously functioning as a pullback resistance level, which finally got taken out last week or last Friday. So what was previously a pullback resistance level could now potentially function as support as well, right? So this is how the first support has been identified for the Aussie. So take note, we did see once again, right, we did see the Aussie spike strongly following the NFP result, but however it reversed sharply after that. So if we do see that bullish momentum continue for the Aussie, then it's quite likely going to stall around the pivot here. Otherwise, we do see a very strong pullback support level at 65.65 for the Aussie as well. Alright, okay, let's see what else can we cover. Alright, let's look at dollar yen as well, right? We've had intervention news last week as well, right? There's been no official news by the Bank of Japan or the Ministry of Finance in Japan themselves. However, it is very many analysts have concluded that the Bank of Japan did intervene on Monday and Wednesday as well, right? So we saw strong intervention measures by the Bank of Japan to prop up the yen, right? If we look at the dollar yen on the monthly time frame, right, just before we do the analysis, let's get a little bit of perspective on how high the yen went last Friday, right, or last week, sorry. It briefly hit 160 or climbed above 160 last Friday, which was a swing high resistance that occurred in the April of 1990. So you can see this is a 34-year high in the dollar yen, right? We have not seen dollar yen hit this level since April of 1990, right? So this is a 34-year high that has occurred. So with the yen being devalued very strongly, the Bank of Japan is prior to last week, there was a lot of talk or rumors that the Bank of Japan was getting ready to intervene in the open markets here to prop up the yen. So when the Bank of Japan intervenes in the market, the yen gets stronger. So that means currency pairs like the dollar yen is likely to pull back sharply, right? So that's what happened last week. So when we look at the daily time frame here, right, we had a suspected intervention take place on Monday, 29th of April, right, with the dollar yen briefly climbing above 160, right, going as high as 160.23. It then pulled back very sharply to drop as low as 154.45. Then it recovered, and then there was another intervention measure that took place on the 1st of May as well, which caused the dollar yen to drop as low as 153. And following that second intervention measure, you could see dollar yen coming under pressure, and it continued to slide lower over the second half of last week. So just to get some perspective on these wild swings on the dollar yen and how the Bank of Japan is trying to intervene in the open market to prop up the yen. So when they prop up the yen, dollar yen, the currency pair dollar yen is likely to fall as well, along with the yen crosses. So euro yen and pound yen, of course, are going to fall as well. So when we look at those currency pairs or these crosses, you can see a very similar price action as well, right? Very clearly, intervention measures have occurred last Monday and Wednesday, causing this strong pullback for the yen crosses and of course for dollar yen. Alright, okay, now with that we can start the analysis for the dollar yen proper, right? So when we zoom out a little bit here, right, we can see previously this was a swing high resistance that occurred on October of 2022, right? You can see very clear swing high market structure here, right, which once again the dollar yen ran into resistance last year, October of 2023 and November 2023. You can see dollar yen sort of like making a double top here before pulling back quite sharply. So we have a strong pullback resistance level here, right, which once again caused dollar yen to stall in the end of March and early April, right? You can see the dollar yen consolidating around 151.50 from 20th of March till the 9th of April. So for about a period of 2 weeks, the dollar yen was consolidating around this level before finally breaking higher. So what was previously a strong pullback resistance is now going to function as support, right? This level now is going to function as support. Right, so that's how the pivot at 151.94 has been identified. This is a strong pullback resistance level. Now, it was functioning as a strong pullback resistance in the past. Of course, now with dollar yen breaking above it and reversing sharply towards this level, 151.94 is now going to function as a potential pullback support level. Not only is it a strong pullback support level, we also have the presence of a Fibonacci retracement. So this retracement started from here, this swing low on 11th of March, of course going up to the high on 29th of April. We see that the presence of the 61.8% Fibonacci retracement aligns very well with the pullback support here. Right, so we did see, although the dollar yen sold off sharply last week, right, last Friday or Wednesday onwards, it sold off quite sharply, right? It did seem to find strong support here, so perhaps we could see a potential retracement to the upside. Remember, after selling off strongly over the last 3 days or in the second half of last week, we may see some short covering take place as well, and that may mean that we could see the dollar yen retrace a little bit higher. Right now, the first major resistance for the dollar yen comes in at this pullback resistance at 156.32. Right, previously you can see here this level, although not the cleanest level here, but you can see how dollar yen did find support here pretty well on 30th of April to retrace higher before finally dropping. And even this spike here, the top of this wick that occurred on 2nd of May, did run into resistance at 156.32 before pulling back once more. So this does look like to be a pretty decent resistance area. That's also been highlighted by the 50% Fibonacci retracement. Right, so this retracement starts from here, this high on the 29th of April, going down to last Friday's low. So we do see this pullback resistance level having the additional presence of a 50% Fibonacci retracement here. Okay, now for the support, right, there's really nothing here. You can see this is a strong bullish move to the upside for dollar yen, and then the next major support for dollar yen is going to come in at 146.42 here. And you can see this is a strong pullback support level, right? As price was rising strongly in January, it retraced back down towards 146.40, found support around this region before bouncing higher, and then once again it pulled back again on 8th of March, finding support again before rebounding higher. So you can see pretty much this is like a double bottom here for the dollar yen before moving higher. So quite clearly this is a very strong pullback support level for the dollar yen at 146.42. Right, let's see if there's a Fibonacci retracement that we could use on this part of the move here. Right, let's start the retracement from this swing low on the 28th of December, going up to the high on the 29th of April. Are there any fib levels that we could potentially use here? Right, we can no, probably if anything maybe the 38.2% might be good to highlight, but otherwise we don't see any other levels line up with the first support. But let's just keep 38 and highlight this as a zone. Right, so we have the presence of a 61.8% Fibonacci retracement from this uptrend here, and then we have the presence of a 38.2% Fibonacci retracement from this other uptrend here. So we do see a pretty strong support zone for dollar yen around the pivot, right? So that is why maybe we could see dollar yen retrace higher today, and also because there may be some short covering that could take place as well. Alright, so these are the key levels for dollar yen for today. Now let's move on over to the commodities. Let's cover gold, and then we'll cover oil as well. Right, and of course, right, do not hesitate to drop your request in in the live chat box, right? I'd be more than happy to go through the analysis with you, right? Should you have any other currency pairs or indices that you would like to have a look at, right? Do let me know, and we can go through the analysis together. All right, now looking at gold, right? So gold hit an all-time high. All right, once again, let's look at the monthly chart to get some perspective on how gold has been trading over the last few months, right? So previously, way back in September of 2011, this was the previous all-time high for gold at about $1,922 per ounce. This level was finally broken, right? This level here was the previous all-time high, right? This occurred on September 2011. Now this level was finally taken out on July 2020. However, the move was not sustained, right? You can see gold prices pull back, consolidate under this level before making a second attempt to break above $1,920 per ounce. It did break above it in March of 2022. However, once again, the move was short-lived before it retraced lower. Right, then again, for the third time in April of 2023, it did try to break above 2075 again, but however, it ran into resistance for the third time, pulling back before finally, okay, and even here, the fourth time, 1st of December, December of last year, it did attempt to break above $2,075 per ounce, but again, it failed, pulled back for a couple of months before convincingly breaking through this level in March of 2024. So you can see this previous level here at 2075 was like a multi-swing high resistance, right? When you zoom in, you can see that this level here previously functioned as a strong multi-swing high resistance that acted as a strong barrier not once, not twice, but actually 4 times, right? Pretty much you can argue this as well. It took a while before 2075 was finally broken, right? Just to get some perspective on how gold has been trading. And of course, once this level was taken out in March of 2024, right, it did make an all-time high, right? All-time high for gold is at $2,431 per ounce. This was the all-time high that occurred on the 12th of April, right? So take note, all-time high for gold is at $2,431 per ounce. Now, okay, back to the daily time frame for gold, right? So as you can see, after making this all-time high, it pulled back quite sharply. It did continue to retrace higher. However, it has actually sort of run into resistance. You can see market structure showing us a pretty decent swing high resistance that occurred that's occurred around $2,400 per ounce, right? So this tells us this market structure is highlighting a pretty significant swing high resistance taking place, right? And we do see, at least since the 3rd week of April, right, the 3rd, 4th week of April, gold prices have been trending lower, right? I could say there's even a potential pretty decent descending trend line as well. There's a pretty decent descending trend line that has taken place as well, or is pretty much in set, sorry, right? So however, we could see gold prices find support around the pivot here. So right, take note, this pivot is a pullback support level that's been identified at $2,285 per ounce, right? We may see gold prices consolidate or find support around this level, and we may bounce a little bit higher as well. So take note, should it bounce and break above this descending trend line, take note, we do have the presence of this descending trend line here. And should we see a bounce off the pivot and gold cleanly breaking above this descending trend line, we may retrace higher towards the first resistance at 2,359. Now this is a pretty decent pullback support level here. Previously this functioned as support on 15th of April all the way till the 17th before retracing higher. So what was previously a pullback support level could now potentially function as resistance. And we also have the presence of a 50% Fibonacci retracement. Oops, hang on, where is this retracement here? We have the presence of a 50% Fibonacci retracement. We started this retracement from the all-time high on 12th of April, going down to last Friday's low. We can see that the presence of the 50% Fibonacci retracement aligned very well with the first resistance. Now for the first support, right, there's really nothing in between $2,200 per ounce all the way till 2,280. This is a pretty huge gap. Where I do see a strong support level is this pullback level here at 2,189, as well as the 50% Fibonacci retracement. So we started this retracement here from this pullback level here on 14th of April, of course going up to the all-time high. We can see that the 50% Fibonacci retracement aligns quite close to the pullback support at 2,189. So we have a strong support zone that runs from 2,189 to about 2,207. Right, so should we see gold being capped underneath this descending trend line, and if the demand for the dollar picks up this week as well, then of course we could potentially see that gold break below the pivot and drop lower. But for now, we may see a retracement to the upside, right? And take note, if we do see a clean break above this descending trend line, then we may see gold retrace higher as well. Otherwise, this is a pretty strong resistance zone here as well. Alright, yeah, alright, Sadelmo, right, let's cover pound yen as well, right? More than happy to go pound yen, but let's just finish up oil and then we'll go to pound yen. Let's quickly finish up oil as well, so we at least cover the commodities for this week. Right, as you can see here, since the second week of February, right, oil has been in a strong uptrend. Take note, this instrument is XTI USD, so this instrument tracks the WTI crude oil futures. Generally, you can see since the 5th of February, oil prices were in a strong bullish uptrend, right? There's a strong channel as well, which finally was broken on 17th of April. So you can see what was previously a strong bullish momentum finally stall around the level of $88 per barrel, right? It stalled around the level $88 per barrel before reversing to drop lower, breaking out of this bullish channel as well, right? You can see generally this is a pretty clear bullish channel for oil previously, and then it finally broke underneath the lower trend line as well to signal the end of this bullish momentum here. Right, I think if we look at the Ichimoku cloud as well, okay, no, right, yeah, so price is trading in the Ichimoku cloud and is going to potentially break below it as well, so take note of that. Okay, but otherwise, remember the cloud itself, when the cloud is green in color and price is trading within it, the cloud itself can sometimes help us identify a potential area of support, which also happens to align quite well with the pivot here. This pivot is a strong pullback support level at $76.53 per barrel. We have the presence of a pullback support here. We can see crude oil prices or WTI bouncing off 76.50 on the 14th of April, 15th of April, 21st as well, and the 23rd and 26th. We can see several times where WTI oil has found strong support, right? This is a strong pullback support level here. Even here you can argue, right, it found decent support here before bouncing higher. And we also have the presence of a 61.8% Fibonacci retracement, so this is indeed a pretty strong support zone, right? We have three factors. We have a pullback support at 76.53, we have a 61.8% Fibonacci retracement, as well as the Ichimoku cloud here as well. So we have three factors that point to a pretty strong support zone for WTI oil. So we are quite likely to see oil crude prices pull back this week, and where it could finally find support for WTI would be around the region of $76.50 per barrel and $77.80 per barrel. So take note, this is a pretty wide range. Yes, I know this is pretty wide range, but it's quite likely WTI could finally find support around here. Now, should this pivot level fail to support prices, then the next major support for WTI oil is this swing low that occurred at the beginning of February, right? You can see price finding strong support here at around $72.20 per barrel, right? Making a significant swing low market structure here. So quite clearly that is the next major support for WTI oil. Right, so we are expecting to see WTI pull back further, but it's quite likely to find support here and retrace a little bit higher should once it reaches this zone over here. All right, okay, let's cover pound yen, and we've still got time, so please do drop your request in for any other analysis that you would like to be seen before we wrap up this today's session. Right, so once again, when we look at the yen crosses, so that means when we look at pound yen, euro yen, as well as dollar yen, you can see a very similar market structure, and you can also see the influence or the impact that the intervention measures have had on the respective currency pairs as well. Similarly, for pound yen, it went as high as 200.58 on Monday, 29th of April. We had the first intervention measure take place on this date, and we had the second take place on the 1st of May. So you can see quite clearly it has made, at least for now in the near term, the two intervention measures have had a major impact on the pound yen. The yen is strengthening or strengthened strongly last week, and that means of course currency pairs like pound yen, euro yen, and dollar yen have fallen or pulled back very strongly from its recent highs. Right, when we look at the pound yen on the monthly time frame, you can see it is not trading at all-time highs, but it is indeed trading at elevated levels. Right, when we see previously this was a major significant swing high resistance for pound yen back in July of 2015. So you can see pound is actually trading at about 9-year highs, right? 9-year highs, of course, and this was the previous swing high resistance back in June of 2007, right? So you can see pound yen is not trading at all-time highs, but it is trading at elevated levels, especially when we look at this previous swing high resistance here. Right, so now we see how yen has been trading, pound yen has been trading. We can also see a pretty decent ascending trend line as well. Oops, hang on. Where is that? Okay, here we go. This is the trend line. I do see a pretty decent ascending trend line here as well on the monthly time frame. Maybe that's going to be useful for us on the daily time frame, so let's just keep it on here. Right, we see a pretty decent ascending trend line as well. Alright, now let's go switch back over to the daily time frame and zoom out a little bit, so you can see, yep, this descending trend line is pretty useful as well, right? It may function as a potential support zone for for pound yen should we see the pivot and first support being taken out, right? So it's good to see. Sometimes it's good to zoom out a little bit, maybe onto the weekly and monthly time frame, to just get a good eagle eye view of how this currency pair has been trading, and which then helps us to identify potential support or trend lines as well. Okay, now let's just zoom in back now. Okay, why do I have this here? Oops. All right, now let's zoom in towards 2024 and see how pound yen has been trading. Right, so previously this was the high for pound yen at 193.38 back in March earlier, which clearly got taken out right in towards the end of April, but now it's swung back underneath this level. So what was previously a pullback resistance level here in March of 2024 could now potentially be resistance. So that's how the first resistance has been identified at 193.38. Right, when I look across 190.33, this looks like to be a strong pullback support level here, right? You can see price finding support here close to this level here on 25th of March, 2nd of April, 15th April, as well as on the 22nd of April here. So this highlights a strong pullback support level that also has the presence of a Fibonacci retracement, which is the 78.6%. Wait, it's not so clear here. Let me try and adjust the labeling. Right, we have the presence of a 78.6% Fibonacci retracement. We started this retracement from this low here on 12th of March, going up of course to the high here on the 29th of April. We see this 78.6% aligned very well with the pivot as well. So let me add in the Fibonacci retracement. Remember, the retracement runs from 12th of March up to this high on the 29th. You can see 78.6% aligned well with this pullback support level here, which has been identified as the pivot. And take note, we can also see that we have the presence of Ichimoku cloud as well. The bullish Ichimoku cloud, with its green in color, can offer or identify areas of support as well. So we have the Ichimoku cloud, the 78.6% Fibonacci retracement, and this pullback level here at 190.33 to help us identify a pretty strong support zone for pound yen. So should it reach down towards this level here, we may see a potential retracement to the upside, right? Maybe a little retracement higher before finally reversing to drop lower. Now take note, so should you have any short pound yen positions this week, right, when markets open, maybe we do see this bearish momentum continue. So if you do have any decide to go short on pound yen, right, either using this pivot level here or this support zone here that's between 190.33 and about maybe 190.50, this would be a good zone to identify as a potential take profit for any short pound yen positions. Right, okay, so this is what I have for the pound, and of course the first support is going to come in at 187.96. Right, we can see price making a pullback here back on 11th of March before finally rebounding higher. So this is how the first support has been identified for the pound yen. Alright, maybe there's another retracement that we could use. Let's try running this retracement from here, 2nd of Jan, going up to the high on the 29th of April. Alright, let's pull up all the fibs. Do we see anything? No, we don't really see any of the other retracement levels aligned well. Maybe I can see, okay, 50% is quite close to the pivot, and 61.8% is quite close to the first support as well. But right now, I think it's not necessary to have these retracements on here for now. Alright, okay, so if there are no further requests, then alright, thanks everyone for tuning in to this to today's webinar. Right, take note, dollar index, a little bit strange price action, right? When we look at it on the 30-minute time frame, right, we had bad NFP data, higher unemployment rate, which caused the dollar to sell off strongly, with dollar index dropping as low as 104.50 last Friday. However, we suddenly saw this index reverse and rebound higher. So it's in a bit of a limbo here for this week for the pound, for the dollar index. That is why I've identified 105. The level at 105 is a very significant overlap level, so I've identified it as a downside confirmation. So that means that should we see a clean break below 105, then of course we're likely to see the bearish momentum for dollar index continue. However, if it doesn't, this level is then going to function as a potential rebound, and we could see dollar index retrace higher as well. Right, should it retrace higher, the first major resistance for dollar index is probably going to be around this pullback resistance here at 106.30, which also aligns well with the Fibonacci projection. Remember, projection is 3 points, 1, 2, 3, so should we move higher, we also have the presence of a 61.8% Fibonacci projection level to identify this resistance zone. First support, right, should we see a clean break below the downside confirmation, first support is this pullback level here at 104.09. right, we can see the dollar index finding strong support here at the beginning of April, which is also a level that has the presence of a 61.8% Fibonacci retracement as well. Alright, and just before we end, let's just go back to the calendar from Forex Factory. Right, take note, these are the key events lined up for this week. Right, there's quite a few things going on, but I just want to highlight the two central bank announcements. We've got an announcement by the RBA, or the Reserve Bank of Australia, on 7th of May, 4:30 a.m. GMT time, followed by the press conference by Governor Michelle Bullock at 5:30 a.m. GMT, followed by the Bank of England's monetary policy statement as well on Thursday, 9th of May at 11 a.m. GMT, followed by Governor Andrew Bailey's speech at 11:30 a.m. as well. So take note, both central banks are expected to maintain their interest rates at current levels. So that means for the RBA is expected to remain at 4.35%, and for the Bank of England is expected to remain at 5.25%, right? As we see here, inflation in Australia is still well above the target of 2 to 3%, right? RBA has a target of 2 to 3%, which they expect to reach in 2025. We do see CPI readings in Australia remaining well above this level. Plus, we also see a strong rebound in PMI activity over the last 4 months. So that means Australia is quite unlikely to cut, but they may communicate a little bit of a dovish outlook. So that means the Aussie dollar could potentially sell off on this date, right? Take note on the 7th of May. Although they are not going to cut rates, RBA is not going to cut rates, but should we see a statement and a press conference that's maybe leaning on a little bit leaning on the side of dovishness, we may see the Aussie sell off. Now, coming to the Bank of England, they too are expected to keep their bank rate on hold at 5.25%. Similarly, when we look at inflation in the UK, right, headline inflation is on the left, core inflation is on the right, 3.2%, 4.2% respectively. This is still well above the Bank of England's target of about 2%. So that means it's quite unlikely they're going to cut rates. And we also see PMI activity rebounding quite strongly since November as well. Remember, it was in contraction in the third quarter of 2023. But however, from November onwards, we've seen a strong rebound in PMI output, which shows a rebound in economic activity. So to combine that with higher or elevated inflation, Bank of England is quite unlikely, or is very likely to maintain its bank rate at 5.25%. But take note, they could once again lean on the dovish side. So that means the pound could come under selling pressure on Thursday, 9th of May, right? And just to wrap up, NFPs was bad last Friday. The US added 175,000 jobs versus the estimate of 243,000. This was a major deceleration in job growth in the US. Not only did it miss the estimate of 243,000, it was also much lower than the 12-month average, right? If you look at the 12-month average of NFP gains, they've come in at about 242,000 per month, right? So we had a bad miss in NFPs. Plus, we saw the unemployment rate edge higher as well. So unemployment rate was expected to remain at 3.8% as what we saw in March, but it jumped higher as well to signal a potential slowdown or weakness in the US labor market. Alright, thanks everyone for tuning in to today's session. Right, do look out for all upcoming webinars by IC Markets for this week, and we'll wrap up this today's session with the ending disclaimer as well. Alright, once again, thanks everyone for tuning in to today's webinar. Do look out for all our live analysis and education content that's lined up for this week as well. Right, take care, have a great trading week, and I'll catch you all at the next webinar. Thank you.